Good morning and welcome to the ESKEN Limited Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated on the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to David Shearer, Executive Chairman. Good morning to you, sir.
Welcome to ESKEN's interim results for the period up to 31st August 2022. I'd like to start with our highlights. The key thing to report today is that we have now confirmed a financing package of £50 million of committed funds with a further £40 million of uncommitted funds that can be released at the discretion of the lender. The committed funds will allow us to fund the outstanding Proprius liabilities, cancel our undrawn RCF, and provide working capital for the group. Lewis will provide more details on this funding shortly, but the key thing is that this gives us certainty and clarity, allowing us to focus on our core aviation and renewables businesses. Those core businesses have delivered a resilient performance in the face of challenging end market conditions. ESKEN Renewables delivered half-year EBITDA of £7 million. This performance followed a series of unplanned outages impacting the higher margin waste wood supplied biomass plants. We also had to manage a reduction in the availability of waste wood arriving at our storage sites, and these two factors reduced the overall level of gate fee income. Rising costs, as expected, have had an impact on margins, and when you strip out the £2.2 million of cost inflation and one-offs compared to the first half of last year, our EBITDA performance is comparable to that period. Inflation-linked contract indexation kicked in on two of our largest contracts at the end of the period under review, and this, along with the start of additional supply agreements, will support improved performance in the second half. Our aviation division, principally London Southend Airport, delivered an improved underlying performance with more flights allowing for better asset utilisation. In the first half of last year, we received £3.5 million of one-off payments, and in this period, we recovered £1.4 million of airline marketing support payments. The improved underlying performance reflects an increase in passenger numbers following the return of easyJet operations with weekly flights to Malaga, Palma and Faro. Overall, the reduction in positive operating EBITDA from our two core operating businesses, offset by a reduction in depreciation and net financing costs, led to a slight increase in total losses before tax to £12.7 million. We also continued to retain £36 million of non-core assets held for sale, following the disposal of a parcel of land at Widnes for £3.5 million. On this slide, we highlight the management actions we have taken during the period. As mentioned on the previous slide, we completed the sale of £3.5 million of land at Widnes, which is in line with net book value, and we have also completed the early return of two aircraft leased by Proprius. This led to a £2 million net cash benefit. However, we have seen adverse dollar exchange rate movements, which has impacted the future cash outflows payable on our remaining Proprius leases. Importantly though, the early return of the two aircraft has provided visibility of the likely associated maintenance cost. We have also made good progress in terms of our work to identify and reduce indirect and support costs, and this work will help us to reduce our overall reported central costs over the coming periods. And finally, I was delighted to welcome London Southend Airport's new CEO, John Upton, who has brought both experience and a start-up mentality to the airport. He now leads a new and invigorated airport senior management team. Before I hand over to Lewis for the financial review, I just wanted to touch on our continued ESG progress. ESKEN has established a series of KPIs across environmental, social, and governance pillars and is now busy making progress against those KPIs. We aim to finalise our net zero plans before the end of the financial year, and an element of the executive team's remuneration is now linked to the delivery of set ESG KPIs. I am particularly pleased to say that ESKEN Renewables achieved Military Covenant Gold Award status, with London Southend Airport achieving Silver status. These awards are important to us, given 10% of our colleagues are ex-service personnel. I will now hand over to Lewis for the financial summary.
Thank you, David. Good morning, everyone, and thank you for joining us today. I'm going to start by providing an update on funding. We've set out the full terms on this slide, but the key points I'd highlight are that the terms are in line with the current debt markets and that we have secured the facility despite the very challenging market conditions, reinforcing our continued ability to deliver on what we say we will do. The funding we've secured on a committed basis allows us to cancel the existing RCF facility, which was undrawn, and provide sufficient funding to settle the legacy Proprius liabilities, which includes lease payments and aircraft maintenance costs. It will also be used to cover short-term working capital requirements. We also have an exchangeable bond which matures in May 2024. The uncommitted element of the loan could be used to part fund the repayment of that bond, alongside the further sales of non-core assets and the sale of the shares in the Logistics Development Group at the time of the bond's maturity. Finally, securing this funding with a new lender has enabled us to remove Lloyds and AIB completely, and the group's transactional banking will move to Barclays. On this slide, we've provided an updated debt timeline and have included the new funding underneath. I'll talk you through each of the debt items, the key dates, and what the new funding means in this context. Other lease liabilities of £18.6 million is our asset-backed finance for items such as trucks and trailers. This is payable over the normal course of business with various end dates. IFRS 16 liabilities, which are those with a corresponding right of use asset or net investment of lease, are split between Proprius and other leases. For the other IFRS 16 leases, excluding Proprius, which are mainly long property leases, £4 million is payable in the next 12 months. The remainder has varying end dates, with the majority running for another 15 to 20 years. The outstanding lease liability for Proprius aircraft leases is £25.9 million, and all payments are due by September 2023. That payment will be covered by the new committed loan. The exchangeable bond of £52.6 million matures in May 2024. This is partially backed by the shares we own in the Logistics Development Group plc. However, there is a shortfall in value between the shares and the amount needed to settle the bond. As mentioned, the uncommitted element of the loan could be used to part fund the bond. The convertible loan between LSA and Carlyle Group matures in August 2028, unless converted or redeemed earlier. Alongside the committed funding, we also have around £36 million of non-core assets which are held for sale and will be realised over time. This slide gives an idea of the debt position after the funding, with appropriate lease liabilities removed, the undrawn RCF extinguished, and the new committed funding added. Now I'll move on to talk you through the results for the period, starting with a financial summary. Total group revenue is £58.1 million, which is a 12.5% improvement on the same period last year, as revenue increased in both ESKEN Renewables and Aviation. EBITDA is £2.5 million this period, compared to a £5.6 million last period. It is worth noting that the previous period included £3.5 million of one-off receipts in Aviation. Loss before tax of £12.7 million is broadly in line with the £12.5 million in the prior period, as a reduction in EBITDA was offset by a reduction in depreciation and finance costs. Net debt excluding IFRS 16 is £164.7 million, which includes the convertible loan between London Southend Airport and Carlyle Group, sitting at £125.4 million at August 2022. Headroom at the end of August was £51 million, and represents cash of £31.9 million and the £19.1 million undrawn RCF facility. This is reduced from the original £20 million as a result of non-core asset sales. Next, we'll take a look at the divisional performance of revenue and EBITDA. These are results from continuing operations only, so do not include Proprius. Total group revenue was £58.1 million compared to £51.7 million last period, and EBITDA was £2.5 million compared to £5.6 million. Aviation revenue increased by 9.5% to £14.2 million, mainly as a result of revenue generated at the Hotel and Jet Centre at London Southend Airport. Renewables revenues increased by 14.1% to £43.5 million, which is as a result of increased volumes and the initial RPI indexation increases on some contracts. One specific high-volume, low-margin plant that was offline for a majority of last year was operating for the full 6-month period to August 2022. Group central revenue reduced as we no longer receive rental income on container assets, which were sold to the lessee at the end of last year. Aviation EBITDA was negative £0.5 million compared to £0.8 million profit in the prior period. The prior period includes one-off income of £3.5 million relating to Connect Airways and Teesside International Airport. The current period includes £1.4 million of benefit from the return of airline marketing payments. Excluding these one-offs, there was a £0.8 million improvement in EBITDA period on period. Renewables EBITDA was £7 million compared to £9.1 million in the prior period. This reflects the mix with unplanned outages impacting high-margin contracts, but also the larger tax credit income in the first half of last year due to catch-ups from earlier periods. Investments reduced in the period as our share of losses in an associated investment were higher than the prior period. Group central costs improved due to savings in rebranding. This slide outlines the movement in EBITDA period on period, starting with the £5.6 million from last period. As I mentioned, this included a one-off £3.5 million benefit, which we have shown separately in blue. This was reported in the Aviation division, hence we can see a reduction this period as a result, with £1.4 million one-off benefit from the current year separated out. We can see more clearly the comparable movement, which is a £0.8 million improvement. Also highlighted here is a £0.9 million benefit in renewables from the prior period. This relates to research and development tax credit and was more significant than usual as it covered multiple years. Excluding this, the reduction in renewables EBITDA was £1.2 million. The total EBITDA for the period is £2.5 million after the movements in the other divisions. This bridge shows the movement from EBITDA of £2.5 million per the previous slide to the loss for the period of £8.6 million. It has been colour-coded to allow focus on cash items totalling positive £0.1 million and the non-cash items totalling negative £10.3 million. Depreciation improved in the period as the overall asset base across the group reduced. The cash finance cost of £2.4 million is £2.7 million of interest payable on leases and debt, less £0.3 million cash interest received. The non-cash amount of £3.7 million is accrued interest of £6.6 million and the release of debt issuance costs of £1.9 million. This is partly offset by the £1 million revaluation downwards of the exchange option on the convertible loan and foreign exchange gains of £3.8 million, which relate to the US dollar denominated loan between our parent company, ESKEN Limited, and Proprius. This is included in the continuing results and is not offset with the corresponding foreign exchange losses in Proprius. As Proprius is discontinued, so is presented separately to the rest of the group. This brings us to a loss before tax of £12.7 million compared to a loss of £12.5 million last period. Tax is a £2.5 million credit, predominantly due to a change in estimation of tax provisions in the period. This means the continuing loss for the 6 months is £10.2 million, of which £10.3 million is non-cash, including the Proprius discontinued business. The total loss for the period is £8.6 million. Here we can see the main movements in cash for the year. Starting with inflows, we generated £4.6 million of proceeds from the sale of property inventory and other PPE, which primarily relates to the sale of land at our site in Widnes. We also received £1 million from property subleases, and London Southend Airport received £0.7 million from new grants. Moving on to outflows, our biggest cash outflow was the repayment of leases and interest totaling £10.7 million. £3.2 million was used in operations, which includes £1 million of tax paid. We also spent £1.3 million on equipment and works at London Southend Airport. Cash flows relating to Proprius of £11.9 million are primarily lease payments on aircraft and have been adversely affected by falling foreign exchange rates. The final closing cash balance at 31st of August was £31.9 million. This includes cash of £10.1 million, which is ring-fenced in London Southend Airport. Moving on to the balance sheet, overall net assets reduced from £70.1 million to £51 million, mainly as a result of the reduction in cash. Tangible assets and right-of-use assets have reduced due to usual depreciation, and the net investment in leases have reduced as we receive contractual lease payments. Non-current receivables reduced as the £1.5 million deferred consideration due from Eddie Stobart on the previous sale of the brand is now due within 12 months. That balance has moved to current and was the driver for the increase in current assets, along with other increases in trade receivables. As we saw on the previous slide, the main movements in cash were the repayment of leases and interest, and outflows relating to Proprius. Loans and borrowings increased primarily due to interest accruing on the LSA convertible loan with the Carlyle Group. IFRS 16 lease liabilities decreased as we make the usual contractual repayments. Other liabilities decreased due to the reassessment of uncertain tax positions and the release of a site restoration provision following the termination of a lease. Gearing has increased due to a combination of increased net debt and decreased net assets. Excluding IFRS 16, gearing is 178.4% and overall gearing is 516.3%. This slide shows the movement in net debt starting with £241.9 million from last year period. Net debt has increased firstly as a result of cash interest paid on leases and accrued interest, increasing the LSA convertible loan balance. Other cash flows, as we saw on the cash slide earlier, are the cash used in operations, purchase of assets, proceeds from the sale of assets, and proceeds from new grants. Debt increased as debt issuance costs are released from the balance sheet over the term of the loan, and the LSA convertible loan value decreased following the accounting revaluation of the convertible option. Including other small movements, the net debt, excluding discontinued, is £253 million, and the closing net debt position at 31st of August is £263.6 million, including the impact of Proprius. I'll now hand over to David for the divisional reviews.
Thanks, Lewis. I'd like to now provide an update on ESKEN Renewables. The business supplied 753,000 tonnes of biomass fuel, up 6.7% on the same period last year. While the volume we supplied improved, the performance of biomass plants that use the higher margin waste wood was down due to unplanned outages. A number of these plants have new long-term owners who are making investments which will benefit performance in the years ahead. The ongoing fluctuations in UK construction supply chains led to a reduced amount of waste wood from construction firms. As a result of this and the unplanned plant outages, total gate fee income was lower. The combination of biomass plant outages during the period reduced gate fee income and increased costs resulted in ESKEN Renewables reporting EBITDA of £7 million. However, when you strip out these increased costs and the £0.9 million of one-offs in the same period last year, ESKEN Renewables EBITDA performance was consistent with the first half of last year. We do expect an improved second half performance as a result of new supply agreements, expected improvements in plant performance in the winter period, and most critically, because 4 of our 6 largest supply contracts will have been updated to reflect annual contract indexation revisions. We provide more detail on those first half headwinds on this slide. On the first chart, we show the volume of higher margin waste wood supplied to biomass plant customers during the period. While forestry byproduct supply was up over 13%, waste wood supply was down almost 7%, with supply to waste wood biomass plants down on the same period last year for every month bar March 2022. On the middle chart, we show the impact of waste wood volume on gate fee income. As you can see, the gate fee itself remained higher than the same period last year for 4 of the 6 months under review. However, the total volume of waste wood arriving at the gate was lower during those first 4 months. We would have normally expected to see waste wood volumes increasing over the summer months, which didn't happen until we lowered the gate fee. Lower waste wood volumes, combined with the unplanned outages, impacted the total gate fee income we received over the first 6 months of the year. On the final chart, we explain the impact of annual contract indexation revisions. As you can see, costs have been rising throughout the first half of the year. However, our annual contract indexation revisions on our largest contracts occur on specific dates. Only 2 contracted revisions occurred early in the first half, with 2 occurring right at the end of the first half. We will see the benefit of these contract revisions in the second half, with final contract revisions taking place at the start of 2023. I'll now hand over to Lewis for our aviation review.
That's great. Thank you, David. We welcomed easyJet flights to Malaga, Faro and Palma throughout the summer. This led to an improvement in passenger numbers from 46,000 to 61,000, resulting in positive operating leverage and an EBITDA improvement of £0.8 million when you allow for both the recovery of airline marketing payments this summer and the one-off receipts in the comparable period half last year. We are well placed to make steady progress next summer with the appointment of John Upton as the new airport CEO, and with confirmation that easyJet flights are on sale now to the same destinations next summer. Of course, we were disappointed to be informed by our partner that cargo operations would end from mid-September 2022, following a change of strategic focus from air freight to road-based cargo. It is important to remember, however, that cargo operations have never been our central focus, and we were fortunate to have been approached by our logistics partner to deliver this operation a few years ago. It provided important income during its peak activity during the pandemic. However, income from the operation had reduced over the course of the year. Though the impact on FY24 is likely to be a £2.9 million reduction in EBITDA contributions for the aviation division as a whole, our intention, however, has always been to focus on developing commercial passenger operations while opportunistically seeking opportunities to leverage the wider airport infrastructure. And that's exactly what we'll be doing this winter, as we support a logistics company on a temporary basis from 8th January through to 25th March 2023. While we of course had far fewer passengers during this summer than other London airports, it was nonetheless pleasing to see we continued to deliver an excellent passenger experience at the airport. That quick and easy passenger experience, combined with our direct trains and significant catchment area, continue to support our discussions with airlines. And I thought it would be helpful to give you some colour on the types of discussions we are having. Before the pandemic, London Southend Airport was serving flights to up to 40 destinations, and we're able to have discussions with airlines about these routes, using data to indicate likely passenger demand. We're in discussions with a number of low-cost carriers, regional and full-service carriers, both UK and overseas based, targeting key beach, VFR and city break markets. Target beach destinations include popular previous routes like Barcelona, Tenerife, Ibiza, Corfu and Alicante. VFR, visiting friends and family routes such as Budapest, Bucharest and Sofia, are large markets with significant passenger volumes from our east of London catchment area. And there are routes shown in green on this map that we haven't previously served flights to, but that we can put forward a strong business case, such as Warsaw, Dusseldorf and Milan Malpensa. There are also routes that can be served by regional and full service carriers to provide connectivity to cities that want new or additional connectivity to London. As the London airport system becomes increasingly constrained, London Southend Airport can provide a solution to airlines seeking additional capacity, and given our geographic location, airlines can access London with quicker flights while using less fuel. All of this means we can have focused conversations where we can be very specific what our ask is, the airlines we want to speak to, and what the likely return is for them. The airport team recently returned from the World Routes Conference in Las Vegas, where they had a range of positive discussions, and I look forward to providing further updates as discussions continue to develop. I'll now hand back to David for the concluding slides.
Thanks, Lewis. In summary then, I am pleased that we have been able to conclude our debt financing in the most difficult markets that I can remember for many years. This brings us stability for the group as we finally clear the legacy liabilities. Our renewables business has proved resilient in what have been challenging conditions, and as highlighted earlier, we have restated our guidance for EBITDA for the full year at £22 million. Our aviation business continues its recovery, but at a slower pace than we would have wished due to continuing disruption throughout the industry, with many airlines focusing on short-term performance ahead of strategic positioning. The medium-term case for LSA remains compelling, and our refreshed leadership team at the airport are well placed as the market returns to normality. As a board, we have decided to undertake a strategic review which will consider the optimum composition and structure for the group. This review will explore all options and may conclude that it is in the best interests of all stakeholders to progress a sale of one or both of the renewables or aviation divisions in order to secure the long-term potential of these businesses and deliver value for our shareholders. We'll now open up for questions. Thank you.
David, Lewis, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab situated on the right corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we received a number of questions throughout today's presentation, and thank you to all the investors for submitting those. Could I just ask you to read out the questions and give responses where it's appropriate to do so, and I'll pick up from you both at the end.
Okay, thank you very much. Well, good morning, everyone, and thank you for joining us. Let me address some of the questions. We have a question: with the strategic review, how do you anticipate managing this alongside looking to grow the businesses as they are two big projects? I think I've probably said in previous sessions like this that over the last 3 years, the top management team have had to spend quite a bit of time addressing the legacy issues and dealing with the various financial consequences of that refinancing. Equally, in the two core businesses, we now have two very good and strong management teams, and therefore there'll be more time available to Lewis and I at the top, along with advisors, to actually deal with the strategic review. So I think it's a good point to make, but we're quite content we have the bandwidth and the capacity with the use of external advisors who we will bring in. Just following on from that, in the strategic review, is anything on or off the table, or are truly all options open? How would we think of the value of any disposal which was a minority versus controlling stake being sold, if anything was sold? I think it's too early to comment on that at present, other than to say we're quite clear that we will look at all and any options in relation to the operating businesses. The board are pretty confident in the intrinsic value of the core assets we have, and where we believe there's an opportunity to recognise value for shareholders, then we will pursue that. I think in terms of commenting on value, it's too early to talk about minority versus controlling stake. We'll update the market as and when we've conducted the exercise. Lewis, there's one there on aviation trends you might want to.
Yes, there's one from Steve K. What trends are you seeing in aviation? What are the catalysts you view as driving growth and therefore asset value of the operations for investors? So I think that what we've always said about the airport is that as London airports fill up, then what should happen is that London Southend is perfectly placed to then take the overflow from other airports as they fill up. We also think there's a real opportunity for the likes of Heathrow carriers who are short haul to actually look to move across and into London Southend, where it's a much better, efficient operation for them, rather than going into a large hub like Heathrow. So I think there's opportunities there. And we are seeing aviation is recovering, but we are seeing caution with some airlines as well as they continue to recover from the pandemic.
Do you want to take the next one as well?
Yeah, so this is from Fiona H. What is the forecast total cash drain relating to Proprius? So that continues to be as we forecast previously. So we're lower 40 million range, and the only difference that we've got is that obviously we are exposed to the US dollar exchange rates there, so there is a slight element that impacts that, but we are generally in line with what we've said previously.
Yeah. And then there's one from Damien on what triggers would make the uncommitted 40 million facility available to use for ESKEN?
So those are very much at the discretion of the lender, and we obviously will be continuing to have discussions with the lender as we move forwards. I also think that we opportunistically chose not to go for a bigger commitment now, given what difficult markets there are, that actually we want to be able to have a look at what the facilities might be available to us next year. So it will be all about timing and a review with the lenders at that point.
Damien's got one about...
Yep, so this is from Damien Brewer. With the yellow planes arriving at LSA next calendar Q1, is there any potential for any to stick after that instead of going back to Stansted if LSA delivers good KPIs, for example? I think, like any business, the real opportunity here is to provide an opportunity for the carrier to try out London Southend. They are there because of what's happening at Stansted overnight, so they're having to move their operation for a short period. I think that it is always great to let somebody try out your product and see just what a good service we can operate for London Southend Airport and them. So we look forward to them enjoying their time with us.
Okay. And then Rob has asked on the strategic review, presumably full exit or desirable, and they say partial exit. Thank you. I think, as I said earlier, I would want to prejudge what we'll decide to do there. It will all come down to value and how we recognise that value. There is precedent, I would have thought, in, for example, airport transactions that selling stakes in long-term assets like that can actually prove attractive. But I wouldn't want to prejudge it. We're just keeping all options on the table at this stage. On the 36 million non-core asset values are falling, how confident are we of further disposals in, say, the next 18 months? I think the thing to remember here is that when Lewis came in 3 years ago, he took quite an aggressive approach to the valuation of those assets, and these are actually supported each year by external valuation. Yes, it's difficult markets, but these are specialist assets that there might be someone interested in, and we will certainly seek to crystallise that value for shareholders over the next 18 to 24 months. Do you want me to touch on it? Yeah.
Yeah. So question from Rob B. Could you touch on trading at the ground handling operation? So that is Start Handling, and they operate out of London Southend Airport, Stansted and Manchester. And I think that what they are demonstrating is extremely good customer service out of Manchester, and that's consistent. And what that's meaning is that we are getting good opportunities to discuss with airlines and continue to develop that business. So Craig and the team are doing an excellent job there.
And then Fiona H, under strategic review, how will value be attributed to each of the two divisions given lost performance? I think when you're looking at, particularly with the airport, it's a long-term infrastructure asset. So the value that's likely to be achieved for that asset is not necessarily a reflection of its current performance. So I think it'd be wrong to think how will value be attributed to each of the two divisions. Ultimately, when we do the review with advisors, we will look at potential range of values, and the market will ultimately decide whether they would support that. And then on the final one, are restructuring options being evaluated to manage Proprius liabilities via corporate structure? We looked at that at the time we took back the planes over the last couple of years, and essentially we negotiated an improved position for shareholders at that time in terms of break clause, and therefore that element has effectively been done. The liabilities, as you see them, will run off, as Lewis said, by September 23.
David, Lewis, thank you very much. I think you've actually managed to address every question that's come in from investors. And of course, the company will review all questions submitted today and will publish their responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, David, could I just ask you for a few closing comments?
Sure. Well, thank you very much, everyone. It's always good to get some questions. They were all good questions there. We're happy to deal with these. I think it's, we take another step forward. We have concluded the financing, which gives us the stability that we need over the next the medium term. That's been achieved in some of the most difficult debt markets I can remember, and I've done a few turns of the cycle, as you can tell by the grey hair. Performance, we've reiterated our guidance on the renewables business, and LSA is starting to recover, and we still have a belief in the long-term recovery of that airport asset. And we will undertake strategic review. The board think it is right to do that. Given where share prices are sitting, not just for us, a lot of companies in the small and mid-cap sector, relative to the intrinsic value of these assets, I think it's right for all shareholders and stakeholders that we explore all options to see if there's a better way to recognize that value for shareholders and securing the long-term potential of the businesses. So the work on that starts now, and we will update the market as we go forward. But thank you for joining us.
David, Lewis, thanks once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of ESKEN Limited, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you.